We just got some huge news from the Fed this week. September 17th, the Fed has officially cut interest rates again for the first time since 2024. Now, what that means is that we're going to see everything go up in price, whether it's gold, whether it's stocks, whether it's Labubus that's going around right now. Everything's going to get more expensive, as we've always seen in the past. But why is that? What's actually going on behind the scenes? What does it even mean for a money printer to go burr? Right? We're going to cover that today, at least in a nutshell, because I guess they have whole semester long classes at universities for this. But we just want to get an understanding. When a lot of money gets poured into the system, money gets sloshed around everywhere. So that causes the prices of everything to go up. But when it's healthy inflation, like for example, the 2% inflation that's been seen as a metric for, I don't know, the last 30, 40 years, for no reason actually, it's only there because Australia decided that 2% was good. So there's no actual real like scientific mathematical number of good inflation. 2% has just been used because it's been understood that, well, 1% inflation might be too little for more money that comes into the economy, whether it's from other countries investing in the country or more people being born or more business being done, right? So 1% was too low, but 3% and higher kind of seems like, well, then people's savings would dwindle down like that, over a few years. So 2% would just seem like, you know what, 2%. We're going with number two. That's what they just decided one day. But this can lead to something very, very dangerous because, as we've seen now, we're not in hyperinflation, right? We've heard that term, hyperinflation. But we are seeing what people are calling the devaluation of the dollar. So in this case, what we're seeing right now and what a lot of people are noticing is that everything's up, everything's up, everything's up. AI is up. Tech stocks are up. The oil and gas sector is up. Everything is up. Groceries are up. So is it a bubble? No, it couldn't be a bubble, right? Because whenever you have everything being up, it's not just one sector. Like, for example, whenever we had the dot-com bubble in the 90s, well, the only stocks that were crazy super high up was in one sector, in the internet, right? The internet sector. It was new, it was fresh. People were throwing so much money in there. And then, literally, in the course of a few days, the stock prices of internet companies, the dot-com companies, dropped over 90% in a few days. So, that's very dangerous, but in this case, it's not just one sector that's up like crazy. It's everything across the board. So that shows us that, yeah, we're not in a bubble. I mean, I don't doubt that there's some areas that are in bubbles, but for the most part, we're not in a bubble. It is the devaluation of the dollar. A big worry from everybody that's investing, though, is that the stock market is near all-time highs. It's so scary to put your money in there. And I agree, it's kind of like daunting. Like, well, everything's already so far up, and I'm gonna put my money in there now. And right, can it go even higher or not? Well, let's check out this chart really quick by Carson Investment Research, where it's times that the Fed has started cutting interest rates whenever the market is at or near all-time highs, right? So it's a little hard to read, but they're in the middle where it says next month, and then next 3 months, next 6 months, next year. And below that, you can see the average returns after a month, 3 months, 6 months. And on the very left is the dates that the cuts initiated. But if we just focus on that bottom piece of that graph where it shows average and median and percent higher, what it's telling us there is the average return or the median return of the stock market within that period of time. And the percent higher means the probability of that actually happening. So in the next month after the rate cuts, which was just Wednesday, a few days ago, you can expect the market to be on average 0.1% higher, the median 0.4% higher, and the odds of that actually happening is 50% of the time, right? But if you keep looking to the right, you can see that progressively gets more and more likely. So much that in history, since 1980, that the Fed has started cutting near all-time highs, 100% of the time, the market has been up on average 13.9%, or the median 9.8%. So now knowing this, why would we think that this time would be any different? Even during the pandemic, whenever it was a worldwide phenomenon of what was going on, the stock market, yes, it did crash whenever the news was starting to go around. We all saw that happen. But the Fed and other governments around the world also came in to save the market. Like, the market's literally at a point where It's too big to fail. Everything is riding on the market now, whether it's the gas sector, the gold. I mean, I guess gold is the opposite. We're going to get into that. But AI, tech, even health sectors, which kind of puts us in a pickle because normally we'd want to be safer with our money and be like, we don't want to take on the risk. But historically, we see that 100% of the time, everything's going to be up from here a year from now. It's 100% likely, historically, anything could happen though, This is not financial advice because, yes, technically, anything could happen. But after everything we've seen, the stock market isn't fair. Like, it's a system, The Fed is going to hold it up no matter what. We've seen it happen so many times. There's no way that in a few years the stock market is going to be lower unless it's a crash and then it comes back up. But it's designed to keep going higher. So yes, actually, today we need to talk about the political and economic state of the world right now. Because we're in a clown economy. It's a circus out there. Inflation is still higher than your neighbor's rent. Job growth is crawling like at 35,000 per month, which is super low actually, by the way. So you cut rates and yes, jobs might live to see another day. But then inflation will come back like the Marvel villain that they refuse to throw away. I'm looking at you, Deadpool. Yes, this is gold. And no, I'm not trying to flex. I just wanted to have an example. This isn't even much to flex. It's from Costco and it's 14 karat. Let's go Costco. The reason why I try to get your attention with that is because gold right now is going crazy up. And I wanted to use that as the example to show, I can't get this. I wanted to use gold as the example to show why everything goes up after an interest rate cut, whenever the money printer goes brr. So if we look at this chart right here, it is the price of gold as I found on Google, right? But I'm comparing it there to the dollar, just a flat line on the bottom. And that's how we all perceive it whenever we hear, oh, gold went up in value. We compare it to like a dollar, a steady line, and gold's value is just increasing, right? But that's not actually how it works. The actual way that this works whenever the money printer is going burr is if we take this image and we flip it upside down, and we invert it, and which I did in this other picture. I just took off all the other details so it won't be a little more cleaner. Now you have gold on the top and you have the money on the bottom. Here we see gold is steady. The dollar is going down. Now it's the same chart that I just showed you of gold. It's just upside down, but this is the best way to picture what it means whenever the dollar is being devalued. It's not that everything is going up, right? That's not the case we're seeing here. We're seeing rate cuts at all-time highs. So whenever you see gold going crazy, it's not that gold is becoming more valuable all of a sudden. Gold is still gold. It is the dollar that's becoming less valuable, as well as everything else. If you replace that line, it won't make much sense because a company has a lot to do with its fundamentals and the actual business behind it. But for the most part, just to get a good example, replace that gold on the top with any company, Nvidia or any Apple, Amazon, and you can see that those companies still have their value, right? But it's the dollar that's being devalued. So then we perceive it as, oh, this company has now gone up in value. In this current economy where it seems that stocks only go up, I fear that actually might be the truth because as we see 100% of the time, the stock market keeps going up once interest rates are cut at all-time highs. What should we do? What am I going to do? Now, I can't tell anyone what to do, of course, because I'm not a financial advisor. But me personally, even though it feels like FOMO to buy stocks at this rate, here in a year, stock market is going to be up another 10%, 13%, whatever we see. So I would recommend to just keep buying into the market, the SPY or VOO, or you can also get some gold, you can get some silver. Overall, the trend is that gold is eventually going to be worth more. It's just how the world works. Eventually, gold will be worth more than it is today. Whether that is in a month or in 3 years, this interest rate cut leaves us a very, very good buy signal that we are only going up from here. So don't overcomplicate things and just look at the historical data and make an informed decision. I know we all watch a bunch of people online that help us with other ways that we can see the economy and what to do with our money. At the end of the day, every choice is our own. If you like this video and it helped you out a lot, hit subscribe because I will keep trying to inform you of this circus of an economy without having to sell you a $500 course to pay for my Wi-Fi bill. This is Jason at Jesus Loves You All, and I'll see y'all later in the next video.